Hello friends and welcome to this video. Friends, in this video, we'll talk about one of the very important concept, Monte Carlo simulation. And we'll also understand how we can apply this technique in the DCF valuation. So before we get into DCF valuation, let's quickly understand what Monte Carlo simulation is. So as the name suggests, simulation, Monte Carlo is a model where we try to simulate various possible scenarios, what can happen in the future, right? And we try to find the best possible case, right, of the future outcome. So here under Monte Carlo simulation, we can run thousands of or 10,000s of simulation, and then we can see the average case. Okay. Now to understand application of this technique on DCF model, I have created a model, DCF model for Airtel, Bharti Airtel, where you can see I have done some key projections here. First, I have projected key numbers of the income statement using some historical trend and using some management guidance. So you can see I have done my projection up to 8 years. After 8 years, I am terminating my projection and I am calculating terminal value directly. Then you can see I have projected capital expenditure, working capital changes, which is required to calculate free cash flows. Then here I am calculating free cash flows based on my base case assumptions, right? So these are my future free cash flows for next 8 years. Post that, I have calculated my discount rate, which is an important factor in the DCF valuation because you need to discount all the future cash flows using this cost of capital. After this, guys, we are calculating terminal value, which is one of the major contributor to your DCF valuation. In many cases, this terminal value contributes even more than 90% of your total DCF valuation. But the normal range of contribution of terminal value can vary from 60% to 80%. Now, why terminal value is so important in DCF valuation? Guys, as we know that usually the businesses are going concern when we do the projection of the businesses. And in this case, Bharti Airtel, we are assuming this company will remain into existence forever. But we are ending our projection at the end of 8 years. Now, after 8 years, lots of life is left in the business, right? So this terminal value will capture value of the remaining life of the cash flows, what business is expected to earn, right? And that's why this value is going to be much larger part of the total DCF valuation. As you can see in the current case, my total terminal value is coming 21,71,000 crores, of which the present value is coming 9,61,000 crores. So if we discount this terminal value, which is at the end of 8th year, right? So this terminal value represents the value of cash flow from year 9 to infinity, and which would discount to the present value, it is coming 9,61,000 crores, right? Now, of this value, right, if we see the contribution of this value to the total DCF value, the total DCF value of equity of Bharti Airtel is 11,63,000 crores, of which 9,61,000 crores is coming from just terminal value, almost 80%, right? So this plays an important role in deciding the total DCF value of the business. Now, I want to run a Monte Carlo simulation on this terminal value. I want to see how this terminal value can be different under different scenario if I make changes in the key assumptions which help me in calculation of terminal value. Right, guys? So here I'll run Monte Carlo simulation on this terminal value. So guys, we all know in the terminal value calculation, there are the three important factors which decide your terminal value. One is your cash flows of next year, means when you are calculating a terminal value, immediate next year cash flows, right? So here growth plays an important role, right? So when you're ending your projection, then post that at what constant rate your cash flows will grow forever, right? Then divided by R minus G. So R is your discount rate and G is again your constant growth rate, right, guys? So we'll run simulation here on this terminal value. So before that, let's understand what are the key inputs which decide your terminal value. So guys, here I have taken a long-term growth rate, the stable growth rate of the business. Here I'm assuming my stable growth rate 6.5%, right? So post my projection period, my business is expected to grow at a rate of 6.5% forever. So here I'm putting here my base case assumption for long-term growth rate. Okay. Next, EBITDA margins. So of this revenue, what profit of what percentage of EBITDA I'll earn. So my base case assumption of EBITDA margin is 58%. So that's my 58% EBITDA margin percentage. And WACC, weighted average cost of capital, which is discount rate, another important ingredient of terminal value. So my base case cost of capital is 11.5%. Okay. So I'll put this 11.5% here. Now, guys, if I make a small change in this growth rate or EBITDA margins, because change of EBITDA margin will result in change of cash flows, and ultimately your all the future year cash flows will change, right? If I change my long-term growth rate, it will change my all the future year cash flows. If I change my discount rate, it will also have significant impact on my present value of terminal value. So I'll see how my terminal value will change due to change in these key inputs. Okay. If I show you changing these numbers manually here, for example, currently this 6.5% growth is connected to my assumption sheet. But if I make it, before that, let me first show you my base case DCF value so that you can see the change. Okay. So my DCF value in the base case is coming 1909, 1909 rupees per share. Okay. This is what the base case value of Bharti Airtel as per my DCF model. Now, just see guys, if I make a small change in this long-term growth rate, say if I make this growth rate 5%, can you see my value has dropped almost by 30%, right? Back to the base case assumption. So, Control Z. Now, if I make a change in my EBITDA margin, suppose if I make this EBITDA margin 50%, again my terminal value is changing substantially. Likewise, guys, if I change my base case assumption of WACC, so if I make it 10%, you can see change in my terminal value, again substantial, right? So now what I'll do after putting here, so you have to punch these values here, don't link them, okay? So you have to punch these values under your base case. Now, standard deviation is what? The change what I'm expecting, the normal change. So I'm keeping my standard deviation of long-term growth rate 1%, right? Either side. EBITDA margins, I'm keeping this range 5%. And WACC, again, I'm keeping this variation 1%. It's a huge variation range, 1% in the WACC, 1% in long-term growth rate, and 5% EBITDA margin. This is my standard deviation. I'm saying this can change in this range. Now, iteration means what are the different possible outcome, right, under these assumptions. So if this base case is 6.5 and the standard deviation is 1%, so what are the different possible outcomes based on the probability, right? So what I'll do here, I'll apply a function here, norm dot inverse, normal distribution dot inverse, right? This function is available in Excel. Then the moment you apply this function, you see within the bracket first it is asking you probability, because there are different millions of different possible probabilities there of the different outcome, right? So here I'm typing random, right? Within range 0 to 1, probability can be 0 to 1 of different possible outcome, comma, mean. Mean is what? Your base case. You have to link your base case scenario, comma, standard deviation. So I'm keeping my standard deviation 1, bracket close, enter. Now every time when you will make any change in your spreadsheet, you will see, not change, if you just click on the spreadsheet, you will see different iteration here, right? So 6.5, again if I enter, it will become 6.9. So different possible outcomes, okay? Now EBITDA margins and WACC, so I can just copy down this formula, okay? Now, guys, you can see my DCF value per share is still 1909. Reason being, these changes are not connected to my DCF model, right? My DCF model is still based on my base case assumption. So what I'll do now, I'll connect these iterations, these reference range to my DCF model. So first I'll link my growth rate here, right? Then this EBITDA margin, I'll link to my model. Okay. And then finally, I'll link my cost of capital. So cost of capital, you can come down and you can link it here. This is my cost of capital cell. Okay. Okay. Now you can see, guys, my final DCF value, which was coming 1909 before, now it is coming 1698 based on different possible outputs. But one of the output is 6.3% growth, 59.9% EBITDA margins, and 12% WACC. But every time if it changes, you will see the change in the value. Right, guys? And likewise, there could be thousands of possible scenarios, right? Because future is unpredictable. We don't know what exactly would be my long-term growth rate, what exactly would be my EBITDA margins, and what exactly would be my WACC for the infinite period. Now, guys, what I'll do, so this is what the base case, what I've created for this model, the basis for my Monte Carlo simulation. Now, I'll run thousands of simulation on this possible outcome. So what I've done, guys, here I've created 1000 iterations. You can see here, I have 1000 iterations. You can run more iteration if you want, but thousands are more than enough, right, to get the average case scenario. Now here in this cell at the top, you will link the final outcome on which you want to run simulation. Okay. So now you have to select this range, this entire range of 1000 simulations. Okay. Both the column. Now you have to go to data table under what if scenario. Click on data table. Now row input cell, there's nothing in the row. So leave it blank. In the column, you have to click any blank cell in your spreadsheet. Okay. And click OK. Now you can see, guys, all possible outcomes under 1000 simulation, right? You can see lots of iteration there. Now, guys, I want to see the average case now. So if I want to see the average DCF value, so average DCF value is coming what? Just average of all possible iterations. It is coming 2076. So under 1000 simulation, my possible DCF output is 2076. DCF value of Bharti Airtel is 2076. Right, guys? So this way we are trying to deal with the uncertainty. Now, guys, let's try to create a histogram chart on the basis of these possible outcomes. So let's select this entire range, go to insert, and then click on this histogram chart. Now let's understand what this chart is conveying us. So if we just enlarge this to understand this well. Okay, guys, now can you see the major concentration of the values, right? So almost out of thousands of iteration, maximum iteration, they're referring a value of DCF value of Bharti Airtel in the range of 1611 to 2041. So the base case scenario, I'll say the base case scenario of this valuation is where the majority of the chances that the valuation will fall in the range of 1641 to 2041. This I can say is my down case scenario. So I'll say in the down case scenario, the major possibility is in case of down case scenario, the valuation is likely to fall in this range, in the range of 1181 to 1641. This is a down case scenario. And upside, the major possibility is what? In case of upside is 2041 to 2471. 2041 to 2471. So I've created three different range of DCF value of Bharti Airtel. The base case is 1641 to 2041. Upside is 2041 to 2471. And down case scenario is 1181 to 1641. So guys, this is how we can use Monte Carlo simulation in our DCF valuation to deal with this uncertainty in the future. So friends, I hope you liked this video, and now you will be able to use this technique in your final DCF valuation model to deal with the uncertainty about the future. In case you have any different thought, please do share your thought process in the comment box below. Thank you.